I always say something to my founders: you are braver than me, because at the end of the day, I'm on the other side. I'm getting my salary, I'm getting paid, etc. I think when you are a founder, you're taking so many risks on so many fronts. So I really think that try to get all the help you can. Try to get those people around you. I mean, can be investors, can be friends, can be colleagues, founders, whatever, that will cheer you up.
What you have to understand as a startup is when you're raising funds and you're issuing shares, for example, to an investor, whether it's now or in the future, you are going to be diluting the ownership of the company.
Do you have any critical legal aspect that founders should prioritize when they are preparing their deck, all the material to reach out to investors? As the founders, how can you make sure your fundraise is successful? Well, you need to be well equipped and you need to be well prepared. Understand what type of investors you want to reach out to, do your due diligence and get prepared. So you know you are targeting the right people, but also you have got the right material. So you need a deck, you need a data room. There is so much that you need to do before you even go out for a fundraise. Otherwise, you will fail. There is a high chance that you are not going to get the money that you need, but most importantly, you are going to get the wrong investor on the table. And that is a big mistake. So in today's conversation, I'm going to unpack all of that with two amazing women that I met in Dubai during STEP conference. One is VC, Syrine Ben Mansour. She is principal at Oryx Fund. And the other one, Suraya Turk, managing partner at Legal Circle. They are two great women with a wealth of expertise in helping founders to succeed. Definitely, if you are a founder in an early stage, you can't miss this discussion. But before we get into the show, I'm going to ask you a favor. If you watch our interviews, you like the content and also the guests that we get on the show, be part of our community. Click the subscribe button on YouTube and follow us on social media. I would love to have you as part of our community. It's so important to get your support, and most importantly, your feedback on what you like, what topic I should be discussing, what are the tough, provoking discussion that you want to hear. And I'm building lots of great things for our community to get more engaged and give them more value beyond the podcast. So I would love to see you with us. Finally, remember that all the content on the channel is for informational purposes only, is no financial advice. And even if on the channel, myself or the guest, we are giving some opinion, you should never act on the back of those, but you should always do your own due diligence and research, learn before you make any investment decision. Hi, Syrine. Hi, Suraya. How are you?
Good, thank you.
Very good. Thank you, Stefania. How are you?
Yeah, I'm fine. I'm fine. It's so good that we finally managed to get together and do this discussion, because we said that in Dubai, after our amazing panel, they got so much attention. It was quite controversial as well, but I think it was one of the most interesting in the investment track at STEP Dubai. So I said we should definitely follow up, get together, and maybe try to address lots of questions, lots of challenges that early stage founders have when they are trying to fund their business and their project. Because, it's not easy as, everybody thinks, right? I'm just going to get $1 million, right? It's not like that. So I'm really glad because, we have got great expertise here from investment perspective, and with Syrine, and then Suraya, you are a legal guru, which, the legal aspect is really, really important when it comes down to building, your cap table and, and through all the growth process of any project. So let's get started with some introduction.
Thank you for having us, Stefania. I'm pretty sure it's going to be a very exciting podcast. My name is Syrine. I'm based in Middle East, in UAE, more precisely. I'm working for a private investment company headquartered in London called Humble Perks. It's a private investment company managing different funds in Europe and in the Middle East across multiple asset classes. So we have venture capital funds, we have venture debt funds, we have secondary funds, and special opportunities funds. I'm leading investment team at the Oryx Fund, which is our early stage funds focused on Middle East companies. So we invest very early. We invest from pre-seed to pre-series A for first investment. And then we have the capacity to follow on up to Series B. We look at a lot of technology companies. We see a lot of businesses. We see a lot of founders pitching on a daily basis. And our main job and responsibilities is to find the right startups to invest in and make sure we guide them and we advise them and we do a lot of portfolio management to bring them to a certain point where we are going to exit them.
So thanks for having me on this podcast. I'm really looking forward to the discussion. Look, in brief, my name is Suraya Turk and I'm the managing partner of Legal Circle, which is a boutique law firm in the UAE focused on the startup ecosystem. So everything to do with a startup, from the inception, an idea and a corporation of their company, all the way through to an exit. And so usually what that looks like in between is we've got our startups who are setting up their companies, then they have, or they go to fundraise, to scale and to grow. We help them with the entire fundraising process, so the entire suite of documents, negotiation with investors and whatnot. And then we also help them operationally as well and with their compliance. So they're, if they're in a particular area or industry, for example, fintech or health tech or any of those technologies which are regulated, we help them be compliant. So we help the startup across the spectrum of law in the Middle East, both UAE and Saudi and the wider GCC. And of course, then on the other side, we support the VCs and angel investors who are making investments into different startups. So we help them negotiate the paperwork and close the rounds, and then support through the entire journey of that startup ecosystem.
Okay, let's get into the main discussion. So kicking off with preparation stage. How do founders prepare for a raise, Syrine?
That's a very good question, Stefania, and I think it's the most important for me. I think the founders need to be ready. They need to know who to approach. They need to be super organized. They need to know who are the investors investing in their sector, in their stage. So what I always recommend to founders is to say, okay, you are an early stage seed round fintech. You need to know who are the investors investing in seed rounds, who are the investors investing in your geography, and who are the investors investing in fintech. That's an exercise they need to do at every single round they're going to raise. That's first. Second, I think it's being super well prepared, where you have the database of investors. You can go, you need to reach out to them. You need to find ways. So for instance, I don't know, you can go and say, hi, Stefania, I can see you are connected to Syrine on LinkedIn and she's working at Hambo Perks. I'm trying to get an intro. Can you please introduce us? I think this is super useful. So try to get the email address or an intro, and then you are going to send an email. This email needs to be super well prepared. You need to know what to say. It doesn't need to be too short, too long. You need to catch the attention of the investors for them to answer. And then you need to share your deck with them. I think when you share a deck, you need to spend a lot of time. Founders need to spend a lot of time preparing this deck. It's the most important document. Why? I should not say that, but it's a fact. It's true. Investors don't go through every single page of a deck. They skim through it and they're going to say in 30 seconds, okay, I want to talk to them or no. So don't send decks of 60 or 50 pages. It doesn't make any sense. I think preparing the deck and make sure the deck is strong enough to catch the attention of the investors is the most important part for me. And I also deliver a lot of workshops on how to prepare a deck, what to include in it.
So just quickly on the deck, what is very important to include? How long it should be? Anything else that you think must be in the deck that you want to see?
Sure. So I think different things. First, I would say how long it should be. It should be like 15 to 20 pages maximum, just for this email to attach it, etc. Then you can have a longer version if you want, that you can put in your data room or you can share during the first meeting or call. But for me, it's like 15 to 20 pages maximum. I mean, it should cover a few parts. First, what problem is the company solving? How is the market? What's the size of the market? How big is the problem? So that's the first part. Second should be how the company is going to solve this problem. What's the solution? So, for instance, I don't know, if you have an app or if you have a platform, founders should not hesitate to put pictures, screenshots to for the investors to understand the user journey and the solution very easily and very visually. Then you should talk about like your journey, your traction. Where do you stand? Did you just launch? Do you have a few months of revenues, of customers? What the traction? And it should be very visual, not a lot of words, a lot of bullet points, straight to the point, use title. I received one day an advice that I really love that I'm using for my presentation, and I think founders should do the same. A presentation is like a newspaper. If you read the headlines, you know what the slide is going to talk about. So really make sure you have the right title. And if I just go skim through the title, I know what you're going to talk about. And this is a bit how you read the newspaper at the end of the day. So you should have that. Then you should have the competitive landscape. I think it's super important for an investor to know where to place you. And in the competitive landscape, there is like two things that I really like, type of graphs. I think one is like just a table where you put your strength, you put your competitors, and you have like tick boxes in green, like, okay, this company has everything and is ticking all the boxes and the others no. I think it's very visual and it helps a lot. Or you have this map or how to define the competition and the competitive advantages. I think the other one is going to be more about the customers or partnerships, etc., that you signed. And the last one should be more around how much you're raising, who are your existing investors, put logos, etc. I forgot one important one, the team. The team is super important. Don't go with a novel about like all the biographies. I think it's more like bullet points. Be as visual as you can. Graphs, logos of companies you worked for, logos of your current investors, the ask, what do you want to do, use of proceeds. I think it's super important. And I always say to the founders, just read and reread your deck, because an investor is not reading your deck properly, to be honest, before a call. And in 30 seconds, we skim through decks. I mean, we receive at Hamburg 2,000 to 3,000 decks per year. If you do the math,
Wow.
it's a lot. And
Yeah.
the investment teams are tiny, and I think it's super important. We know what we like. We know our investment stage. In a deck, in 30 seconds, 1 minute, I know if I want to talk to this company or no. So I think it's super important to prepare your deck and make sure it catch the investor's attention.
Suraya, the lawyer perspective. So,
Yeah.
do you have any critical legal aspect that founders should prioritize when they are preparing their material, their deck, all the material to reach out to investors?
Yeah, look, absolutely. I agree with everything Syrine has said, but that really that's part of the, if you fail to plan, you plan to fail. So what Syrine pretty much said there was, have a really good plan, have a really good, robust pitch deck that when they have a look, they see in a moment. Now, from our perspective, we look at the end stage of that plan. And the end stage of that plan is it's great you have a product that is solving a problem in the market. But now, how much do you need to raise is the $1,000,000 question. And that is what the focus of our attention typically is as lawyers, because what you have to understand as a startup is when you're raising funds and you're issuing shares, for example, to an investor, whether it's now or in the future, you are going to be diluting the ownership of the company. And so one of the main things for an early stage startup is always to begin with the end in mind. And the way to do that is to say, okay, if I know the result of fundraising is going to be dilution of my company, then what do I want the dilution of the company to look like? And you can essentially reverse engineer through using a cap table and seeing if I've promised 10 investors X amount of money on this specific valuation, what will the dilution of my company be when I go to an equity financing round, for example, at a Series A? So that's the first thing that you need to think about. You always need to be looking at the dilution or the result of the raising of funds. But more importantly as well is, if I raise funds today, what am I raising these funds for? What runway are those funds going to give me? Because fundraising is a very long journey and it doesn't just stop after the first fundraise. If you're in AI or you're in fintech or you're in these, industries that require a lot of capital, you can be sure that you are going to have multiple fundraisers. And so with multiple fundraisers, you're going to be diluted each and every time. And so what you want to be making sure is that if I'm going to have a fundraise every 12 to 18 months, how much do I need to raise in each to give me runway till the next raise without diluting myself so much so that I lose control of the company before we go to an equity financing round, for example. And so there's a balancing act of, taking money from an investor and understanding what the consequence of that is versus, understanding how much it is that you really need and negotiating only that amount in each raise. So you're not taking less than what you need so that you don't have enough runway, but you're not taking more than what you need so you're not diluting yourself more quickly in those rounds. And it's just a constant balancing act. But I mean, once you've got, as Syrine said, once you've got that deck done, dusted, it's clear, it tells the story, then it's really mechanical and it starts to be very technical around the amounts, the valuations, the dilutions. And this is what, I think a fund or a startup that's going through a fundraising process really needs to understand, and it's not easy, right? It takes time, it takes experience. Even seasoned startups can often make, I guess, misjudgments or mistakes on those aspects.
Yes. So, Syrine, let's focus a bit on the valuation, which is always a challenge, and everything that Suraya said is just super important. You need to kind of strike the right balance on the investment ask, but at the same time, when you go to the VC, they are never happy with your valuation, and they always try to, actually you are overvaluing your business. So what is the right approach to valuation? And perhaps what is your VC approach to that?
Yeah, that's the $1 million questions, Stefania. I think it's a combination of things. I think what Suraya said is a very, very good point. As a founder, you need to keep your dilution in mind, and I think you need to start from that. You need to start from, I need to have 18 months to 24 months of runway minimum. So 18 months, let's say minimum. I need to have this runway, so I need to raise X, so 1 million, 2 million, whatever. And then I know as a founder, the dilution is between 15% to 25%. 25 is the very high range. And usually 10 to 25, I would say. 10 is a bit low. So usually you need to know that every round you will lose between 10 and 20% of your company. So if you do the math and you reverse, you know your valuation. That's a bit first what founders need to know. And if that doesn't work out, or they're like, no, this valuation is way too low, or I'm getting diluted too much, whatever, this means you either need to raise less or you need to split kind of your fundraising rounds. What I say by that, sometimes I have founders saying, okay, Syrine, I'm raising this round because I want to scale to the B2B side, but as well, I want to scale to this geography. No, if you do this, that means you need to raise a lot, and it doesn't make sense in terms of valuation. So really, I think what Suraya said is very true. You need to raise what you need for the next 18 months to reach certain KPIs and milestones, first. Second, starting from that, as soon as you know how much you are going to be diluted maximum, you know kind of your range of valuation. You know that. Then you need to understand, and this is the exercise we are doing as a VC, by the way. Then what you need to know is like, who are the international references? What comparable companies I can take within the market, public and private, who have a similar business model as I have, but is based in US or is based in Europe or is based in Asia, etc. And you look at the revenue multiple. I mean, depending on the business model, so revenues multiple, customer multiple, etc. Whatever the metrics you are going to take to justify this valuation. But as a founder, know that as VC, we do this exercise. But as a founder, I think it's super important to keep your dilution in mind and to know what is acceptable or not. I have some founders that are like, I don't want to dilute myself a lot this round. I'm ready to accept a maximum 5% dilution this round. This is very low, and VCs are going to push back. And if you go and accept 25%, I think there is another thing to keep in mind. What is how your next round is going to look like, your dilution, your valuation. You always need to do that. I think it's just a matter of founders will try to push for the highest valuation possible, but you always need to think of the next round. Who is going to pay for this valuation? I mean, okay, if now we're going to invest at a very high valuation, do you think the company is going to be more valued than this valuation at the moment? And I think that's a topic that I love, because I think sometimes founders are going to accept the first offer from VCs and the highest one from investors in general that are not, I don't know, that can be family offices or no, non-institutional investors that are going to propose very high valuation. But I think there is two cases in that case. Who do you want to see on a cap table? And second, are you sure that the next round you will be able to raise at a higher valuation? You don't want to show down rounds. You don't want to show that this round I'm raising at 30, next round, because I can justify it, I'm raising at 15. This doesn't make sense, and it's not a good signal for the market and for the investors and your future investors to just accept the highest valuation without thinking of next rounds and KPIs and milestones. So
Yeah.
I think it's a combination of a lot of things.
Especially if you raise in the bull market, then then you are going to face
Exactly.
some kind of challenges. Suraya, maybe can you outline a few ways that founders can get investment? We know there is, the straight equity. We know there is the convertible loan. We know there is safe. So I think just quickly, just a few definitions so we can, because those, they impact valuation anyway. And your dilution especially.
Yeah. So essentially, the concept of valuation comes into play the same way on a safe and a convertible note, right? Because a safe and a convertible note are instruments that are used in the scenario, in the situation where you take money from an investor today, but you give them shares in a future equity round. And the number of shares that you give them, or the dilution of the company, will be dependent on the valuation and whether that valuation cap is met or not. And so the idea of a valuation cap on these instruments, say safe and convertible, is that if you don't meet that valuation cap and it comes under, then you as an investor benefit from that lower valuation, which means you get more shares or more equity. However, if in the subsequent round, the valuation of the company is actually higher than the cap, the valuation cap gives the investors a protection in that they will convert and get equity on that capped valuation amount. So it's a win-win. Now, the scenario or what you were describing of where there's direct equity. So for example, an investor comes in and subscribes to the shares of the company and say invests $1 million for 10% of the shares. That's a little bit different. In that case, the valuation or the price per share in the company is already predetermined, and we know what the ownership looks like. So it's very clear. $1 million for 10% is going to give you, for example, 100,000 shares of the company. The only time where there's the variance of, what is the investor going to get and whether it's higher or lower is where we set metrics that are defined using future data or future information. And this is why it's super important when, Syrine is talking about valuations and using valuation models that are robust or that compared to, what's happening globally for that startup. Those valuations where they're quite fluid and they're not set today in an equity, exchange are super important for a startup to be constantly. And even if you have to do the mechanical technical exercise on a cap table where you're modeling out what the potential could be. Now, Syrine said something really important about valuations as well. You want to be super realistic. You don't want to come too high. You don't want to go too low. If you go too high and it's not maintained in the future rounds, you've got down rounds, which aren't good for anyone because then you're going to be diluted very heavily. And then, of course, you don't want to be taking less than what you want either, because that's not going to give you enough runway. So again, it comes back to, a balancing act.
Yeah, I feel like having all these metrics can be quite difficult for early stage project, just because maybe you don't have a product ready, you don't know, the market, the reaction of the market. So you might just have got a great idea and, a potential addressable market, but those metrics are not so clear. So perhaps a convertible or a safe is maybe the most common way for those type of funders to raise money. Now, Syrine, you mentioned, and also you, Suraya, you mentioned about this building this cap table. How is important to get the right number of investor and type of investor. They are not acting as a money machine, but they are also giving advice, supporting you. So let's dive deeper a bit into this, into the recipe, the magic recipe to build a really good cap table.
So for me, I feel like the really important consideration when it comes to cap table is it's not just about the money, it's smart money. And when we use the term smart money, it's about what added value does that investor bring to the company or to that raise. And so when you're looking at who you want on your cap table, you want a combination of investors that are giving you, money because they believed in you in an early stage. They're typically your angel investors that come in the really, really early rounds. But as you start to grow and as you start to fundraise in subsequent rounds, you want VCs or you want investors who are now going to give you smart money. And smart money is about, tapping into their network. They will introduce you to other key players in the markets. They will introduce you, for example, to technology officers or the other companies that are doing similar to what you're doing so you can learn from best practice. They will give you and open as many doors as you need in that space. So typically, it could be an investor who specifically invests, for example, in portfolio companies that are similar to yourself. So he's got the go-to, the network, the knowledge, in addition to money. And that's what you want, because those smart investors are also going to give you less headache. They understand the game. They've had very similar experiences with other startups before. They can tell you what to do, what not to do, what's worked, what's not worked. And that's ideally what you want to see. And I feel like a lot of startups sometimes get too carried away and just think about, I need X amount of money to survive. This is what I need. And it's the be all and the end all. However, often what we've seen later is they're scrambling to clean up a cap table and get investors off the cap table who have become, headaches because they don't understand the game or they're not experienced in that industry. They don't actually have the network or, the opportunities to open doors for that startup. And the startup realizes later on, well, I've got money, I've given him shares, but that's all that is. I need more. How do I get him off the cap table to make room for others? And this is, often with the dilemma, right, of early stage, really running with the concept of just let me take money from anyone, rather than it being very strategic and thought through, which I think is very important in that fundraising cycle.
I completely agree with you, Suraya. And I think, when I'm dealing with founders, I hear a lot of things. I hear like, I want to raise from only one investor, or I don't want angel investors, or I don't want any institutional investors, or I don't want an investor who asks for a board seat. And I think those are all wrong thoughts in a way, because I always answer, we don't mind about having angel investors or institutionals. We both have different values and bring something else. I love having angel investors, and I highly recommend everyone to have angel investors on the cap table. I think having only one investor is less of a headache for the founders, but at the end of the day, that means having less people helping you on a daily basis. And I think on the board part, I know it's very controversial, but I am in favor of investors if you have investors who want to sit every quarter in a room with you for 2-3 hours and just guiding you, giving you advices, telling you how to expand to this country, which profile you need to hire, etc. This is, for me, better than any money you will raise, because $1 is not equal to $1. And at the end of the day, you really need to find the investors who are going to help beyond the money. And that's exactly what Suraya said. But investors who are willing to give from their own time, who are willing to help you, who are willing to open the network for you. Because at the end of the day, and especially when it's an early stage company, you don't have a lot of resources. You are really, I mean, you are really tight on cash. You need to do a lot of things. I mean, if you can get an intro, because you are a fintech, if you can get an intro to a regulator, or if you can get an intro to a bank for business development, I mean, this is for me better than raising $100,000. So I really think that having different types of investors, but who are all going to help beyond the money and open doors and, I mean, guide you in different ways, that's for me amazing. I would really recommend to every single founder, even if you raise, as Soraya said, a safe note or a KISS or convertible, whatever, which is not an equity round. You are not. So when you don't raise an equity round, you don't need to put a board in place, because your investors are not shareholders. They are note holders. So at the end of the day, you don't need to do that. But I highly advise you, even at a pre-seed stage, just do. It's not a matter of authority or governance. It's just a matter of having people in the same room brainstorming on your company for 3 hours every quarter. I highly,
Yeah,
highly recommend to put a board in place.
I think, Syrine, what you're saying there is really, it's the difference between a board of directors and a board of advisors. So board of advisors are more in an informal capacity, and they advise you, advise you from their own experiences or experience helping other startups, and they don't dictate necessarily what you can and can't do. However, they advise you from a best practice what you should do. And that's different from a board of directors where they sit on the board and they actually make those operational decisions, and they have voting powers that need to be taken into consideration. So I agree with what Syrine said, but on the other hand, I also think in the early stages, I don't typically recommend startups to have board of directors in the very, very early stages, because you as a founder know how you want to steer that ship. Typically, you know what the vision is, and you really need to be allowed to and encouraged to develop and flourish the ideas. Whereas if you have a board of directors in the very early stages, they might steer that ship in a very different way, depending on what they see is going to be a better outcome. However, when you have a board of advisors with the industry expertise, the practice, the knowledge, it's not now voting power. However, it's more consultation, it's more advisory, it's more recommendation. And I think that is more useful in the early stages.
And I'm going to come to that because I see lots of early stage companies, the way they build those advisors is obviously, like you said, Syrine, they don't have much cash. They can't actually hire an advisor and pay him a certain retainer. So they give them a small stake in the company, and they build this advisory board with industry expert, giving them a shareholder position. Do you think that is a good way to think about it? Or that could actually lead to problematic in the future, and it's much better to have actually an advisor that you hire, you pay in cash, you get the advice, and that's it.
The concept is a fair exchange. And I think the way a startup needs to look at it is, what value is that advisor bringing to me? And how do I compensate them fairly? Now, the way to protect yourself, because I know what you were saying there about, do you give them cash and not give them any equity? Or, if you're bootstrapping and you're strapped for cash, give them equity and no cash. The idea is that either way, depending on what your circumstances are, whether you give them cash or equity, even though typically what we see is equity exchange, you can control the involvement because of the type of share that you would give to an advisor. So typically when you give an advisor, you would give them shares based on maybe perhaps milestones or value that they've helped you achieve. And when you do give them share, it's a non-voting share, or it's a share with a lesser right that they participate in when and if there is an equity financing round or there's an exit for everyone. And that way they sit on the cap table, but they sit there as more of a passive role rather than an active role. We're having, ordinary shares with voting powers that you need to take into their consideration on, operational or shareholder decisions. So there isn't much risk in that, so long as, again, you're not over promising, because you have to understand that it doesn't matter whether they're voting powers or not voting powers. Ultimately, there will be dilution.
Yeah, I think sometimes startup they are a bit too. They have a higher expectation on the advisor in the sense one thing is a passive role and one thing is actually I need to hire a BD, but actually this is very great. So let's get the advisor to do the BD. But you can't do that if you're only paid with a common share, for example, or something that is going to become your reward in the future. So I think it's the question to find the strike balance as well. And I think also founders should be careful to manage their expectation, because not all the advisors are there able. There is a certain amount of time anyway that everybody has in a day to dedicate to clients. I don't know, Syrine, if you have got different experience that you want to share or more insight.
In my opinion, I think when you are in early stage startups, it's very complicated to pay advisors, as you said, because you don't have the money for that. Advisors who are more like your investors and then have an agreement with advisors that you pay, as you said, that will help on the BD, or you will give them a certain, I don't know, a fee if they bring you a deal, etc. This is something that you can do. I think it's less advisors. I would call them more like consultants or introducers or
Yeah.
whatever. I think advisors is more, I mean, you are an early stage startup, so just get your advice from your investors and help from your investors for free, I would say. And then I think what I like is to see for more late stage companies, I like to see a board and a board of directors in this case, but with one independent member that is coming with a sector expertise or with coming with a certain expertise that you are missing because your investors don't have it. I think this is something I like as well.
Let's say the scenario that I'm a founder, I reach out to a VC and the VC for some reason reject a meeting. Could be because it's not the right timing, because you haven't achieved the right milestone, or because he's not interested, but he's not expanding on the rejection. As a founder, what should I do? Should I come back to the VC with more context? Should I just leave it? How? Because I think lots of founders face that situation. They reach out to all the VC, like you said, they reach out email, and then they don't hear back, or they hear back from us, oh no, I'm not interested, oh no, it's not the right time, but there is not much context attached to it. So how founders should deal with that type of answer?
I think few things. First, I mean, target your VC well. You know who you are sending your deck to. Our investment strategy is very clear. It's on all our website. You cannot imagine how many founders are reaching out to me and they're too late stage for us, or they're not within our geographical scope, etc. So I think like just targeting the VCs in the proper way will avoid this kind of situation. Second, let's say you are within the investment, the sweet spot of the VC, etc. But you get this answer. I would say don't hesitate to send an email saying, listen, I can see that I'm within your investment sweet spot, that I should, can you please give me more feedback? Sometimes they will answer, sometimes no. I would say something else. Usually they don't get an answer. It's not like a negative answer. They don't get an answer. I don't think like VCs, and that's not a good practice in my opinion, but I don't think they go back to founders to say, like, I'm not interested. They just leave it like this. And I think don't hesitate to chase. Third, if you're really convinced that you want this VC because you know they invested in the space, they are not investing in one of your competitors, etc., try to find, as I said, a common connection, and just they redo the intro for you. I think those are the kind of things that you
Okay.
can do.
Okay, great. Finally, the due diligence, as a VC, what is the due diligence process looking like, and how long does it take?
For us, it takes around 2 to 3 months. Not the GD phase, but I would say from the first meeting to get an IC approval, I would say 3 months and a half. And for different reasons. First, I think we're doing a lot of due diligence compared to other funds. We want to have reference calls. We want to talk to your employees. Some of the employees want to talk to all the co-founders. We want to talk to your biggest customers, maybe supplier. We want to talk to existing investors. So it depends. I think every VC are doing things in a different way. For us, that's the case. I think what we look at, I mean, we want to look at the traction. We want to understand really how the revenue concentration, if there is any concentration by country, any risk by country, because you have too much exposure in one country or too much exposure on one customer, etc. So we really need to understand what you have built. I think the tech part is super important in our job. So usually either people are doing a tech DD or they have an intern CTO, they have someone who understands that, but you need to understand really the defensibility of the product they build. And then it's like spending a lot of time with the founders. At the end of the day, you're investing in founders, you're investing in their vision. You know, when you invest very early, that the probability to pivot, to rethink the business, to do something else is very high. So the idea, you want to back the right founders, you want to buy hustlers, you want to back someone who is not going to be shy to say, listen, I think I have something, I don't think I have the right product market fit, I want to change my business model. You want to back the founders who are not going to give up after a few months. This is more like where you want to spend a lot of time with the founders. I think it's a combination of a lot of things that we're looking at. And of course, the size of the market. I think it's super important to make sure you have. So I live in the Middle East, and basically UAE alone is not enough. You cannot scale a business and be a unicorn with UAE alone. So, for instance, you need to scale to other geographies. You need to know that the founders you are backing have the ability to scale outside their home country, and they can expand easily. So I think those are the kind of things you need to look at, and we are really cautious on due diligence. And then, so this is like done internally, but then we hire lawyers such as Soraya, who is going to come and do the legal DD. We want to make sure they have the right licenses, they cooperate in the right jurisdictions, that us as an investor, we don't have any risks when we invest in this company, so that the founders have, I don't know, founders agreement, vesting period, where we know they are committed to the company, that the company is hiring people with employment agreement, that everything is done in a clean way. And this is where we have external lawyers coming and giving us the comfort and doing their own legal due diligence as well.
So, Soraya, that's a perfect time for you to jump in. Debrief us on the importance of, getting certain time of certification and things that need to be in place to make sure that the VC feels comfortable in investing.
Yeah, absolutely. So my advice to all startups is to start creating their data room from the day they incorporate their company. And a data room is very structured. So it should have multiple folders for, your licenses, your compliance certificates, your approvals. Then it should have an employment or HR folder where all your employee contracts go into. You have all your supplier and vendor agreements, for example, or your accounting, your finance, your auditing. So all the very, important parts of the business should have their own folder where all of the documentation relating to that part of the business is structured all together. That way, for example, when you're talking to somebody like Syrine from a VC, they say, look, share the data room. We will go into it. If there are any questions, if there is any gaps, if there's anything missing, then we'll come back and ask you. And that really makes that process really streamlined and seamless. It's easy for the founder, and it's easy for the VC or institutional investor or even angel investor. And what we find is when a startup is very organized, everything is where it needs to be. The data room tells the story. It's very clear, when they set up, when they hired, when they fired, when they fundraised, how they scale. The data room gives you a really good picture of the mindset and I guess the way that founder operates. And the clearer it is, the easier it is to do due diligence and the quicker it is to actually get investment into the company.
And I think something else, and Soraya is so right. For instance, as an investor, okay, let's say you prepared your deck, you send the email, you get an answer from a VC. They want to get on the first call. And then the VC is super excited. They love what you're doing. And they're like, can you please share access to your data room? I see a lot of founders saying, yes, of course, my data room is not ready now. Give me 3 weeks to 4 weeks. And the thing is, like, you just lose the momentum, and that's it.
You just lost time and momentum.
Exactly. So I think it's super important before coming and fundraising, your data room needs to be ready from day one. And it's a very good tips. I didn't know that, Soraya. I will tell this to my founders. But from day one, yes, because I think it avoids to miss any documents. Everything is clean. It's not you're not going to have a headache because you are creating this data room for your fundraising purposes. But really, don't lose the momentum when investors say that, and you're like, okay, I will get back to you in 3-4 weeks, because then they follow up. You have 50% chance the VC will miss your email, or that's done. And they were very excited in the beginning.
Yeah. Okay, well, that was such a great conversation. Thank you so much for coming on the show and share some such great advice. I'm sure that many of the founders that watch our show are going to find it very useful. Thank you.
Thank you so much, Stefania.
Thank you. Thank you for having us. Thank you, Syrine.
Thank you, Soraya.